Hey everyone, FinTech here. Today I'm going to be going over my stock portfolio performance for the month of August. And while it's not up nearly as much as it was for the month of July, because of all the earnings reports that happened this August, it was still a pretty eventful month. To start out with, here's a list of my current stock portfolio positions as well as what percent they make up of my portfolio. These may not all add up to exactly 100% due to rounding in the different numbers, and you'll also notice that I actually sold out of my Livongo position after they merged with Datadog last month. As a whole, my self-managed portfolio was down 0.87% this month, or a loss of $958.30. This is not overly concerning to me because I really have a lot of confidence in the positions I hold, and a big portion of that loss was due to Alteryx, which was down almost 30% in the month. So let's start there with the dive into each of these individual companies' performance, starting with Alteryx. Alteryx provides a platform that allows both highly technical people and non-technical people to perform data analytics. I first saw the value in Alteryx when I heard that PwC had actually dropped them as an accounting client so that they could make more broad use of Alteryx's tool. I figured, how valuable must a platform be that PwC is willing to both drop Alteryx as a customer and pay for the price of the tool just so that they can use it without there being a conflict of interest? That must be a pretty useful tool. Additionally, Alteryx has been growing like crazy, posting increasing revenue growths of over 50% a year. That is until they reported earnings this past August. This month, Alteryx had a monthly performance for me of negative 31.98%, or the equivalent of a $2,987.75 loss. Now, this was due to them reporting a slowdown in their rate of acquiring new customers, a slowdown which I think is overblown and I talked about in a previous video. Now, while I don't think this is a permanent slowdown, and I think fundamentally the company is sound, it's going to take a while before the stock makes any drastic moves up or down. And in the short term, I decided to sell a little bit of Alteryx because some of my other positions are performing really well despite the economic slowdown. I am still holding a piece of Alteryx though, so that when the time is right, I can buy back in. My next smallest position is Cloudflare. Now, Cloudflare is a new position for me this month, which I bought partially using proceeds from my Alteryx sales. Cloudflare offers internet network services. Think CDNs, DNS, and DDoS protection. They're used primarily for both their performance and their security. Now, Cloudflare was down a little bit for me this month, around 2.65% or $128.96. Now, there was no real news for them this month. They didn't report earnings or anything. But if we look back to their last quarter of earnings, they were up 48% in terms of revenue, and they forecast for Q3 to be up an additional mid-40s in terms of revenue growth. During these hard times, Cloudflare is really focusing on selling to customers who spend over $100,000 with them each year, and that has clearly paid off, where they've seen that group of customers grow 56%. Management still has very positive outlooks for the companies, and I do believe that this is a position that will continue to grow in the future. Next up, we have Fastly, another relative newcomer to my portfolio. Fastly offers the ability to do edge computing. This video that you're currently watching on YouTube is being served to you by an edge location computer that's physically close to where you are. That's the reason that you can stream it live and you don't have to wait for some server across the country or across the world to feed the data to you. Fastly is both building out this edge computing network for CDNs, but also for other applications where you need a lot of computing power close to the source that is accessing that power. Fastly is retaining customers at 133%, meaning not only are they not losing customers, those existing customers are spending 33% more each year on their platform. The company is continuing to grow due to their exposure to the growth in web content, including platforms like YouTube and TikTok, other platforms like that. But they're also going beyond that niche, and they're working to future-proof their products to support future technologies that may not even exist yet. Now, Fastly had kind of a weird month in terms of their stock price. At one point in the month, their stock was up almost 50%, and then a few days later, it was back down to where it was before. For the month, it is down 13.87% after reporting earnings this quarter, which was interesting because the earnings they reported were good. I guess they just weren't as good as what the market was expecting. Revenue grew 62% this quarter compared to growth of only 38% last quarter. And they did this while continuing to drop expenses, as their gross margins ended up growing to 61.7%. As you can probably tell, I really think that Fastly is a good company, but short term, they do face a risk from their relationship with TikTok. Now, currently, TikTok makes up around 12% of the traffic on their platform, and 50% of that comes from the United States. Now, if you've heard talks in the news about TikTok potentially getting shut off in the United States, that means that 6% of Fastly's revenue is at risk if that were to happen. Now, this would only be a one-time effect if that were to happen, but it would definitely show up in their next quarter. Quick pause here. If you're enjoying this video, make sure to leave a like. It really helps boost the video's engagement and makes YouTube push it out to a wider audience. Okay, back to the video. Next up is a stock which I've held for a little while, Okta. Okta is an identity access management tool. Think single sign-on. They basically manage all the sign-ons for an organization to their different apps that their users might have to use. Okta was down 1.65% this month, or $201 for me. Okta reported earnings on August 27th, and the numbers seem pretty good to me. Similar to Fastly, Okta is retaining customers at 121% each year, meaning that they don't lose customers, they actually sell more to their customers on average each year than they did the year before, 21% more. Additionally, they grew their revenue to $200 million this quarter, which was a 43% increase. They also grew their gross margin to 78.9%, which is amazing, especially considering how fast their revenue is still growing. This also just happened to be Okta's first profitable quarter. Clearly, the market didn't really care that much, which makes sense because the CFO warned that the next few quarters won't necessarily be profitable. Honestly, this company hasn't had any huge news. It's not super flashy like some of the other companies I own, but it's a solid, strong, growing company, and I think that eventually it's going to grow and the share price will reflect that. Next up, let's look at Datadog. Datadog sells software subscriptions that allow companies to monitor their application performance, infrastructure, and security all through what they call a single pane of glass. Datadog was down 10.3% this month, or $1,419.35. The reason for this is Datadog reported earnings on August 6th that on the surface actually seemed pretty good. They grew revenue 68% this quarter while decreasing expenses. Management did express confidence going forward, but they acknowledged the fact that a lot of companies are more focused on saving right now and not necessarily spending on new products. Now, like I mentioned, Datadog's stock did drop after earnings, and honestly, the only reason I can think for that is the market expected a bigger beat than they actually delivered. Now, honestly, based on the rise in Datadog stock this year, this isn't unreasonable. My stock position, even after this drop, is up 126% year to date, or over $14,000. Honestly, I would buy more of this stock, but it already makes up 23% of my portfolio, and I don't want to be too concentrated in it. So for now, I'm just going to have to hold and wait. Next is probably my best known company, Zoom. Zoom offers the best video conferencing platform in the world. And in addition to offering a great platform, they've been directly in the center of the cultural zeitgeist over the last several months. Zoom is basically what happens when a great product, good management, and some really lucky timing all coincide to make one spectacularly performing company. Zoom was up 21.61% this month in anticipation in a beat in their earnings, a beat which I predicted in my earlier video, which I will link to here. Those earnings actually came out in September, so if you've seen the massive growth in Zoom stock since then, none of that growth is actually included in the performance for this month. I did already make another video talking about what I thought about the earnings report, and I'll link to that video here if you just want to get my thoughts on it without having to wait for my September portfolio review. And last but not least is my largest stock position, Crowdstrike. Crowdstrike is a software security company that provides endpoint protection to organizations. They've seen a massive growth in the use of their platform with everybody working from home and all those additional endpoints that need protecting. Crowdstrike was down 8.52% this month, or a loss of $2,056.50. This month's drop, as well as Crowdstrike's drops after they reported earnings, seems to just be the market giving back some of the 17.19% gains that they had last month. Basically, the market was expecting a bigger beat in earnings than they actually delivered. Crowdstrike will continue to benefit from the shift to the cloud, and it is still growing at an impressive rate. It reported revenue growth of 84% while increasing gross margins to 76%. Again, because this is already such a large stock position for me, I'm just going to hold this one and watch what it does. Despite most of my positions in my portfolio being down at least a little bit this month, my net portfolio was basically at zero due to some gains from both Livongo and Zoom. Now, I'm very happy with this, especially considering one of my companies, Alteryx, experienced a 30% drop after releasing an earnings report which showed that they were being drastically affected by the economic slowdown in ways that nobody would have predicted. Despite many people claiming that the market is currently being irrationally exuberant, I haven't really seen that with my own stocks. Most of them dropped after earnings. This seems to reflect the fact that the market does care about fundamentals and they're only willing to pay so much for a stock. The thing you have to remember is stocks aren't priced based necessarily on the current value of the company. They're based on what people think the value is going to be in the future. This is especially true with these really high growth stocks like the ones I invest in. A year from now, if they're growing revenue at 100% a year, the company is going to be worth more money, and you have to price that into the price of the stock. Just because the fundamentals of the company might be different from a slower growing company, maybe in the manufacturing sector, doesn't mean these stocks are necessarily overvalued. They may just be pricing in growth. Now, I believe that these stocks are going to grow, and they're going to grow faster than what the market expects. And it's because of this that I think that I can make a return on investment over that which the market would give me by just investing in an index fund. This is why I hold these stocks. With that said, I hope you enjoyed this video. If you did, make sure to leave a like. And if you don't want to miss out on any future videos, make sure to both subscribe and hit the notification bell. I'll see you next time.